Welcome, everyone. Welcome to Office Hours with Michael Kitces. So I want to talk today about the rise of ETFs and actively managed ETFs in particular. So as many of you know, I'm a partner back to an advisory firm. I kind of write on the blog. And actually a big part of what I do these days is a lot of consulting with companies that serve advisors. So everything from technology vendors to asset managers. And I've been getting a lot of questions and inquiries lately of basically asset managers trying to figure out and working with us as advisors, what's the deal with advisors and actively managed ETFs? Is this going to take off? Is this thing going to take off? And so I want to talk a bit about that theme of actively managed ETFs in particular. So certainly when we talk about ETFs in general, I'm not the first to recognize like just the massive growth of ETFs over the past decade or so. I think when we go since the 2008 financial crisis or since 2008, equity mutual funds in the aggregate have been in net decline on assets. Equity ETFs have added something like $1 trillion. I think the total size of the ETF marketplace is now over $3 trillion. It was a minuscule fraction of that 10 or 15 years ago. So we've had this massive shift. And now, frankly, what a lot of fund companies are trying to figure out is what's driving the shift? Like what's causing it? What's making this happen? So is it because investors are abandoning active management and going to passive, right? So there's kind of this discussion of maybe the rotation is no more active, rise of passive, and ETFs are just the quintessential passive vehicle. But there's also a question, well, maybe ETFs are just doing better because they're cheaper. Now, obviously, some of the cheaper cost of ETFs is because there's no active manager in the picture to get paid. But to be fair, there's also structural benefits for ETFs being cheaper. The biggest of which is just with a mutual fund, the mutual fund company has to actually be the record keeper that gathers in all the information about the mutual fund shareholders, keeps record of who's a buyer, who's a seller, what trades went off, net them out appropriately, make sure everyone's got their appropriate share price based on the NAV. So there's this record-keeping overhead burden for mutual funds that ETFs don't have to deal with. Because at the end of the day, it's simply a share and the investors do their own trading and set their own price. And we already have an existing brokerage account infrastructure about how to hold ETFs the way that we hold stocks and bonds. So there's been this view from mutual funds where they've said, look, we feel disadvantaged because the mutual fund structure has some higher overhead and administrative costs. If only we could get to ETF structures and get rid of that layer of administrative costs and bring our costs down a little, maybe we could get the actively managed asset manager complex growing again by driving lower cost active funds. And certainly we've seen a non-trivial amount of research now coming forward that says, part of the problem with active managers, and part of the problem for some active managers is they actually added value on a gross basis. They just didn't add a value net of costs. So maybe if we can bring the costs down, we can get the adoption of actively managed funds back up again. At least this is the view of some active ETF managers. I say active managers. They're looking at launching active ETFs and trying to figure out whether this is going to hold. And I have to admit, I think they're going to find that their efforts largely fail, at least amongst advisors. And here's why. As I do it, I think the heyday of actively managed mutual funds for advisors basically ended 10 years ago. So if we dial the clock back maybe 30 years ago, so we go back to the 80s and 90s, that was really the heyday to me of mutual funds, because that was the heyday where the financial advisor was a mutual fund salesperson. Like that was what we did. We used to be stockbrokers, then discount brokerage eliminated stockbrokering. You couldn't make your money on stockbrokering. So we sold bundles of stocks in the form of actively managed mutual funds. And asset managers paid us to distribute them. We got commissions, we got some 12B1 fees. But the growth of the mutual fund industry was mutual funds paying advisors in the forms of various types of commissions and trails to sell their funds. Now that started to change in the past 10 to 15 years. And basically it's a technology change. The internet showed up. Online brokerage accounts showed up. Suddenly consumers could buy the mutual funds directly, right? Like why buy from a registered reputable broker dealer when I can buy the mutual fund on E-Trade or Schwab.com, and I can find the good funds from Yahoo Finance or Morningstar.com or Kiplinger Magazine even. So advisors just the business wasn't in mutual fund sales anymore, and we started backing away from it. Right, the advisor had to find the next value proposition, and we did. Those of us on the investment side of the industry, we became asset allocators, right? Anybody can pick a mutual fund, but we give you a broadly diversified asset allocated portfolio, and then we'll manage it for you on an ongoing basis. And this has been the rise of wrap accounts, the rise of the registered investment advisor, basically the explosive growth of the AUM model is all built around this idea of I don't just sell you some mutual funds and plug them into your portfolio. I build an entire asset allocated portfolio and then monitor and manage it for you on an ongoing basis. Now, here's the next dynamic that shifts. As the AUM model grows, it started changing the advisor value proposition itself. Not just because we went from mutual fund salespeople to asset allocators, but because it changed the nature of our business. When you go from a commission-based distribution business to an asset management business, suddenly your incentives change as an advisor. Simply put, I get paid more now to actually give my clients good ongoing service, because they retain, and it encourages advisors giving service. So we see the growth of wealth management firms, the huge increase in financial planning activity, explosive rise in CFP certificates, because now we suddenly have an opportunity to deliver financial planning and get paid for it on an ongoing basis. Now, the second dynamic, though, that crops up with the growth of the AUM model is as advisors, we've just started making big businesses the way we never did before. Now, technically, big advisory firms are still like tiny micro businesses relative to the U.S. business landscape. But relative to the advisory industry, we have made huge businesses since we shifted from being mutual fund salespeople to asset allocators and portfolio managers. If I dial the clock back 20 years, like a big advisory firm was an advisor and had one or maybe two admin staff whose salaries are basically covered by 12B1 trails to do the basic servicing when clients called and asked questions, which is sort of the point of the 12B1 fee, to handle some of that servicing. But when we shifted to the AUM model and suddenly advisors were building on a 1% AUM fee, firms started getting big. Because at a 1% AUM fee, I can hire a material number of staff to give awesome service to my clients, and I'm incentivized to do it because I want to retain my clients, because that lets me retain revenue and have an excellent business. So suddenly we went from advisors who were all tiny solos working under broker-dealer platforms into independent advisory firms that had tens of millions, then hundreds of millions. By a couple of years ago, it was a race to be $1 billion firm. Now the biggest firms are racing for who can get first to $10 billion, and there's a couple that are already north of that. So the whole landscape has shifted. And the reason why that's meaningful from the perspective of mutual funds and ETFs is it makes it possible for the advisory firm to actually start doing the portfolio management hands-on. And I think this is a key point. This is actually the biggest, I think, like undertold change about what's happened as the advisor business model has evolved over the past 10 to 15 years. When the client pays me to manage their portfolio by whatever process I have, the expectation increasingly is the client is paying me to manage the portfolio. And if the client pays me to manage the portfolio, they're not so happy when the first thing I do is buy other active managers to manage the portfolio, right? Because at some point, clients is like, why am I paying you if all you do is buy them? Like, if all you're going to do is buy them, I can buy them directly and cut you out of the middle, right? And advisors risk getting disintermediated if you're going to be doing ongoing portfolio management if you're not actually managing the portfolio. So the pressure came on us, then you have to manage the portfolio directly. So advisors started doing it, right? We see the building out of investment teams. More and more firms start creating their own investment teams. Some of them actually hire CFAs and a whole investment infrastructure around themselves. The larger they get, then they start becoming TAMP platforms and offering it to other firms. And you see RIAs buying other RIAs because they built an investment process and now they want to leverage it out to other folks. So advisors started actually becoming hands-on asset managers in a way that they really never were before. Now, the interesting dynamic that I think has cropped up is advisory firms started becoming hands-on asset managers, but most of us are still not big enough to do individual stock picking and bond picking, right? We've got a little investment infrastructure, but not that much investment infrastructure. And so advisory firms started looking at how can we add value, some kind of management value, when I'm not going to go stock picking. And what we landed on were ETFs. They're kind of the perfect intermediate size building block, right? They're more diversified than just buying stocks, so my clients still keep their diversification value. But I can manage, I can trade, I can tactically adjust amongst ETFs. I can say my value is I create the right, the better, the more accurate, the more effective, the more efficient asset allocated diversified portfolio. In a world where we already know the dominant portion of investment returns are dictated by asset allocation, as advisors, we took control of the asset allocation design process, and we used ETFs as the building blocks in order to do it. So that starts to change the whole landscape, because what it suggests is the shift from advisors using mutual funds to advisors using ETFs is not really an active versus passive trade. It's an outsourced investment management versus internal investment management trade. I think part of what we're actually seeing with the growth of ETFs amongst advisors is basically, as advisors, we're disintermediating mutual fund managers and saying, no, I'm going to do the investment management process myself. Or not me literally, but someone in my firm, my investment management team, our scaled resources, this structure and process that we built up. That's the huge change, I think, that's underway. It's not about passive versus active. It's about who's necessarily delivering some of the active stuff, the active activity that's in there. And of course, how active is it, right? I know some firms that are still mostly passive with their ETFs, but a lot that are more tactical with them. They're not necessarily day trading them. This isn't an all-in, all-out thing, but this is maybe adjusting factor weightings, right? Dialing up on small cap or value and then watching small cap and value get overvalued and then saying, now we're going to dial back on small cap and we're going to dial up international, and then we watch the dollar move and then Brexit happen and we're going to dial up gold. And so tactical shifts start happening as the advisor begins managing amongst asset classes. And of course, we can do this with the go anywhere like mutual fund, but go anywhere funds haven't really taken off as much. And again, I think that's because the advisor doesn't want to buy the go anywhere fund. Advisor wants to feel like they're the ones delivering the value with the portfolio design process. So bringing all this back to our original theme about why I'm very skeptical that actively managed actively managed ETFs will succeed, at least with advisors. It's because even if they're cheaper and they're using the ETF structure, there's a growing number of advisors that don't want to outsource that part of the value chain anymore, right? It's basically a redundant cost layer for the client. If your advisory firm, from the client's perspective, if your advisory firm can be a portfolio manager and add value, I don't want to pay your costs and the active manager's costs. I want to pay your costs because I hired you. And so I'm very skeptical that actively managed ETFs are going to get much traction because of this dynamic that as advisors, we have disintermediated active managers of mutual funds and ETFs because it's still the active manager that we have disintermediated. Alternatively, I think what that means is if you do see any traction start building and actively manage ETFs, if they do succeed, it's going to primarily be as a direct-to-consumer kind of thing, not the advisor channel. And of course, that's assuming the actively managed ETFs can figure out how to make all this work at all with the challenge of transparent ETFs and then the risks of front-running. Eaton Vance has their exchange-traded mutual fund structure, kind of this hybrid thing, so they can make it less transparent. But if we see some activity, I suspect what we're going to find is that it's more on the direct-to-consumer end than the advisor end. Now, to be fair, if the companies can get the cost down enough and deliver some value and actually get positive alpha out of their actively managed ETFs, perhaps some advisors will show up, right? If there's value being added that is justified beyond my fee because they're doing what they do in their space and they're adding value, I think an advisor would still consider that. But, if anything, I suspect if we see growth around active ETFs at all, it may more be because advisors actually start doing them themselves. And a little of that's happening already. You've got Meb Faber does it with his Cambria ETFs. Wes Gray does it with his value shares and momentum shares. RIA is actually building their own ETFs, taking advantage of some of the unique tax efficiencies of the ETF structure to run their own proprietary strategy as the advisor, not to be a third-party manager necessarily for other advisors. But part of the point here at the end is just, I think fund companies are still treating us advisors as though we're product distributors, right? We distributed their products for years. They pay us some commissions. We distributed their products. And the change that's happened is we're just not product distributors anymore. We're becoming product distributors less and less every day. The 1% AUM fee may look familiar, but it's not a 1% trail on a C share anymore. It's a 1% portfolio management fee paid by the client who expects us to deliver value for that, or we're getting fired. And when the pressure is on the advisor to justify their AUM fee and what value they're bringing, hopefully we're doing it through financial planning and some other good advising as well. But the pressure comes on advisors to say, then I got to find the lowest cost solutions, and I have to add value in how I design the portfolio, monitor the portfolio, and manage the portfolio on an ongoing basis, which means the burden's on me as an advisor, and I don't necessarily want to delegate that out to mutual funds. Perhaps the third-party asset managers, we certainly still see growing TAMPs. Frankly, I'm biased. Our firm has a TAMP offering as well. But I'm very skeptical that it manifests itself in actively managed ETFs. I'm just really not convinced it's going to be there, not because the structure's necessarily fundamentally flawed, not even to make this about an active versus passive kind of debate, but because for advisors who believe they can add value in active, I think what you're going to increasingly see is we build our own investment teams, our own investment infrastructure, and we try to do it ourselves. I can debate about whether that's good or bad. There's probably a couple firms that should be outsourcing that process and not trying to build it themselves. But when you look at just this, all the discussion we have about the downward pressure on fees and this question of whether the 1% AUM fee is going to buckle, I think what you're seeing the first round of this already, which is the first way that advisors are squeezing fees out is not to take their own fee cut. It's to stop paying active managers and to bring it in-house at a lower cost. So we'll see how this plays out. I guess for a couple of actively managed ETF providers that are trying to build this, best wishes to you. Hope you can prove me wrong for your sake, but I will see how it plays out. I think the whole shift that we've seen is that the growth of advisors has actually brought investment management in-house, and that this ongoing decline of active management is not necessarily because all advisors are going passive. It's simply because the advisors don't want to outsource the investment management. And then if the advisor is going to be a little more active, stock selection and bond selection, most of us don't have firms that are deep enough to do that. ETFs provide a more convenient building block. And then we tactically manage the ETFs because the returns are driven by the asset allocation anyways. And we can tactically manage the asset allocation through ETF building blocks. So I hope that's helpful, at least for a little food for thought about the current landscape, all the discussion about actively managed ETFs and whether they're going to gain traction or not. Again, I've been fielding more questions from this, both hearing some of it from advisors and a lot from companies I consult with as well. So thought we sound off on it for office hours. So thanks again for joining us. We really are going to get back to the regular schedule soon. 1 p.m. East Coast time on Tuesdays going forward from here. I know it's been messy because I was traveling for weeks and weeks for speaking engagements for advisors. Finally, we're dialing that down into the summer season, and we'll get back to a regular time. So hope this has been helpful for all of you, and have a great day.